There is a legal account in America where your money grows for decades and you never pay a single dollar of tax when you take it out. Not lower taxes, not delayed taxes, zero, forever. Most full-time workers either do not know this account exists or they use it completely wrong. And that mistake quietly costs them hundreds of thousands of dollars before they ever reach retirement. In the next 7 minutes, you will walk away with the full Roth IRA playbook, the 2026 rules, the exact contribution limits, when you can pull money out without penalty, the backdoor strategy for high earners, and a 5-step plan you can execute this week. Let us get into it. A lot of us were raised with simple financial advice. Work hard, save cash, trust what you can touch, maybe gold, maybe a savings account at the bank. And that mindset kept families alive. It paid rent, it built a foundation worth being proud of. But here's the problem. Saving money in a bank account, while inflation runs at 3 to 4%, means you are not actually saving. You are slowly losing. The balance goes up, but the purchasing power goes down. You feel safe, and you are actually falling behind. The United States tax code has legal tools built into it that are specifically designed to help people build real wealth. Most hardworking people never learn how to use them, not because they are not smart enough, because nobody ever sat down and explained it clearly. That changes right now. A Roth IRA is not an investment, it is a bucket, a government-approved, legally protected bucket where you place money that you have already paid taxes on. Inside that bucket, you invest in index funds, ETFs, or stocks. That money grows over time, and when you take it out the right way, the IRS is legally forbidden from touching a single dollar of that growth. You pay tax on the seed, and you keep the entire harvest. Every dollar of profit, every dollar of compounding, every dollar of growth over 20 or 30 years is yours. Not partially yours, fully yours. You open a Roth IRA at a brokerage. Fidelity, Vanguard, and Charles Schwab are the most trusted and widely used. It takes about 10 to 15 minutes online. You connect your bank account, you deposit money, and then you go inside the account and purchase investments with that money. This step is critical. The bucket needs something inside it to grow. Most beginners do well, starting with an S&P 500 index fund or a total stock market index fund. Low fees, diversified, and historically strong over long periods. Or if you want it completely hands-off, pick a target date fund for the year you turn 65. It automatically adjusts as you age, and you never have to touch it. Now let us talk about the 2026 numbers, because these are IRS-verified and current. If you are under age 50, you can contribute up to $7,500 per year. If you are 50 or older, the limit rises to $8,600. That extra $1,100 is the catch-up contribution, and it increased this year. For eligibility, if you are a single filer, you can make the full contribution if your modified adjusted gross income is under $153,000. It phases out gradually between $153,000 and $168,000. Above that, the direct contribution is off the table, but not the strategy, and we will get to that in just a moment. If you are married, filing jointly, the full contribution is available under $242,000. It phases out between $242,000 and $252,000. Two rules you absolutely need to know. First, you can only contribute what you actually earned that year. If you made $4,000 from a part-time job, your maximum contribution is $4,000, not $7,500. Second, you can still contribute for the 2025 tax year all the way until April 15th of 2026. You do not have to wait until January. Every month of compounding counts, and that extra time matters more than most people realize. Now, if your income is above the limit, do not close this video because you are not locked out. There is a completely legal strategy called the Backdoor Roth IRA, and here is exactly how it works. You contribute to a traditional IRA. There is no income limit for that contribution. Then you convert that traditional IRA into a Roth IRA. You pay tax only on any small amount of growth that happened between when you contributed and when you converted, which, if done quickly, is nearly zero. The result is money sitting in a Roth IRA growing completely tax-free, even though your income was above the direct contribution limit. Thousands of high earners across the country use this strategy every single year. The back door is open and it is available to you. Now let us talk about when you can actually take your money out, because this is where most people get confused. Inside your Roth IRA, there are two completely separate pools of money: your contributions, which is the money you actually deposited, and your earnings, which is the growth that built on top of that. These two pools have completely different rules. Your contributions can come out at any time for any reason with zero taxes and zero penalties. Always. Because you already paid tax on that money before it went in, the IRS has no claim on it when it comes back out. Your earnings are different. To withdraw earnings completely tax-free and penalty-free, two conditions must both be met. You must be at least 59 and a half years old, and your Roth IRA must have been open for at least 5 tax years. Here is a clock trick that most people miss entirely. The 5-year clock starts on January 1st of the tax year in which you make your first contribution, not the actual date you deposited the money. So if you open your Roth IRA in March of 2026, but designate that contribution for the 2025 tax year, your 5-year clock already started on January 1st of 2025. You are over a year ahead before you even made the deposit. Open your account and make your first contribution as early as possible for exactly this reason. If you withdraw earnings before meeting both conditions, you will typically owe income tax on those earnings plus a 10% penalty. Treat the earnings as locked until retirement, unless a true emergency comes up. And here is one more advantage that almost nobody mentions clearly. Traditional 401k accounts force you to start withdrawing money at age 73, whether you need it or not. The IRS calls these required minimum distributions. Even if you do not want the money, you are forced to take it out and pay taxes on it every single year. A Roth IRA has no required minimum distributions during your lifetime. None at all. You can let that account continue growing until you are 80, 85, or 90 years old. And when your spouse or your children inherit it, the withdrawals are generally tax-free, though they will need to fully distribute the account within 10 years of your passing. You are not just building retirement income. You are building a tax-free legacy for the people you love. Let me give you a real number so this stops being abstract. You are 30 years old. You contribute $7,500 per year, which is about $625 a month. You invest it in an S&P 500 index fund. The market returns an average of 7% annually, which is actually conservative based on historical data. By age 60, your account balance would be approximately $708,000, all of it tax-free. Now run the exact same scenario, but starting at age 40. Same contributions, same returns, same strategy. By age 60, you would have around $307,000. Same discipline, same monthly amount, same investment approach. $400,000 difference, because one person started 10 years earlier. That is not a motivational speech. That is compound interest mathematics. The math does not respond to intentions. It responds only to action. Here is one more comparison that puts it all in perspective. $500 a month in a high-yield savings account earning 4% annually for 30 years gives you approximately $343,000. That number is taxable, and it depends entirely on interest rates staying where they are. That same $500 a month inside a Roth IRA invested in a total stock market index fund at 8% average annual return gives you approximately $745,000. Every single dollar of it available to you tax-free. Same sacrifice, same discipline, same 30 years. The difference in outcome is over $400,000, and not a single dollar of it taxed when you withdraw. Would you rather pay taxes now on $7,500 or pay taxes later on $700,000? Because that is literally the choice sitting in front of you. Now, before the action plan, let us talk about the 4 mistakes that silently destroy Roth IRA wealth before it ever builds. Mistake number 1 is opening the account, but not actually investing the money inside it. This is more common than most people realize. Someone opens a Roth IRA, transfers money in, and leaves it sitting as cash. The account exists, but nothing is growing. A Roth IRA is a bucket, and you must fill it with investments. After you deposit your money, go back inside the account and buy an index fund. That step is not automatic, and skipping it costs people years of growth. Mistake number 2 is pulling earnings out early without understanding the full cost. Say you withdraw $20,000 in earnings before age 59 and a half. You pay income tax plus a 10% penalty, which could be $5,000 to $7,000 out of pocket immediately. But the deeper cost is what that $20,000 would have become. At 7% over 20 years, that money would have grown to nearly $80,000 tax-free. You did not just withdraw $20,000, you eliminated $80,000 from your future. Mistake number 3 is assuming the income limit means you are locked out forever. You are not. The Backdoor Roth IRA exists precisely for this situation. High earners are not excluded from the strategy. They just use a different door, and that door is wide open. Mistake number 4 is not opening a Roth IRA for your spouse. Even if your spouse does not work, you can contribute to a Roth IRA in their name using your earned income. This is called a spousal IRA. 2 accounts, 2 contribution limits, 1 income. This is one of the most underused advantages in the entire United States tax code, and most couples never take advantage of it. Here is exactly what you need to do this week. Step 1 is to check your eligibility. Pull up your most recent tax return and find your modified adjusted gross income. Single filer, if you are under $153,000, you qualify for the full contribution. Married filing jointly, if you are under $242,000, you qualify. If you are above those numbers, the Backdoor Roth is your path forward. Step 2 is to open the account. Go to Fidelity, Vanguard, or Schwab. It takes 10 to 15 minutes. You will need your Social Security number or ITIN, your bank account information, and a government-issued ID. Step 3 is to automate your contributions. Decide on an amount you can commit to consistently. Even $100 a month builds real momentum over time. Set up automatic transfers so it happens without you having to think about it every month. Pay your future self before you pay anything else. Step 4 is to invest the money. After your deposit settles, go inside the account and buy an investment. An S&P 500 index fund, a total stock market fund, or a target date fund for the year you turn 65 are all solid starting points. Low fees, diversified, and simple. Step 5 is to leave it alone. Market drops are completely normal. Volatility is the price you pay for long-term growth. Do not check it every day. Do not panic when the market falls. Let time and compounding do the work you cannot do manually. And every time your income goes up, raise your contribution amount. Even $50 more per month makes a dramatic difference over a full career. You came here to build something, not to survive until you cannot work anymore and then figure out what is left. The Roth IRA is one of the most powerful legal tools this country offers. It sits there, available to you right now. Every month you wait is compounding that never happens. Every year that passes is growth your money could have been generating while you were working. Make the decision your future self will thank you for. Start this week. One thing before you go. Send this video to one person in your life who is working hard but has no plan yet. Not your whole contact list, just one person. A coworker, a sibling, a cousin. Someone you know is grinding but has never heard of this account. That is how information that actually matters gets to the people who need it most. Drop a comment below and tell me, are you just opening your Roth IRA or have you had one for years? And if you want me to go deep on the Backdoor Roth IRA step by step, or how to combine a 401k with a Roth IRA for maximum efficiency, type it below. I build these videos around what you actually need next.